boring ideas really work in shorts. But since everything is stacked against you in shorts, when you're looking for those quote home run type shorts, those frauds, those accounting irregularities, that type of thing, what you find is one, they're very crowded names. There's not a lot of great short ideas out there. There's not a lot of companies that actually fit that parameters. Our markets are efficient enough that they flush a lot of that out over time. Now, there aren't a lot of those type of names, and they tend to be very crowded, and they tend to be very binary. And to be successful on the short side, it is more important to control your losers than making winners. As important as a long side, it's even more so in short side since everything's stacked against you, and since you theoretically have the capital loss in short.
Let's go boom.
Hello, everyone, and welcome to another episode of What's the Alternative, the show where we dive deep into the nuances of alternative investments with the experts in the field. Today, we have Michael Marone as our guest. He is the co-founder and co-chief investment officer at Crescent Rock Capital Management. Prior to being a co-founder at Crescent Rock, he was a partner at Pennant Capital Management. It's actually where he met Boris, who is the other co-founder of Crescent Rock. Crescent Rock is one of the newer partners to the Bonrian Capital Management alternative platform, and proud to say one of our first pure hedge funds. An exciting opportunity to learn more about the hedge fund space, long, short, and what it means to manage portfolios in a manner that's a little bit different than what the advisors that we work with are used to. So I would like to welcome Michael to the show.
Thank you. Good morning.
Good
Thanks
morning. Thank you for being on the show. As I mentioned, it's a pleasure to have you. Crescent Rock is our first official hedge fund, pure hedge fund-like strategy on the platform. We've had hedge fund-like ETFs and mutual funds, but never a hedge fund. And I think that's interesting. And one of the things we will talk about for our viewers is about how the constraints of the 40 Act really do result in a different experience than, say, working outside of the constraints of the 40 Act. But we'll just start with the current market environment because there's plenty to talk about there. And in a long short equity portfolio like the ones managed at Crescent Rock, the macro environment and the opportunity set is being significantly impacted by all kinds of things going on. So can you talk to us today a little bit about market structure, the impact of macro news on stocks in the short term, and how that leads to volatility and dispersion of returns, and how that kind of drives your process?
Sure. Let's start with market structure a bit, because the market structure from when I started in the business it is quite different. I mean, I started in the hedge fund business in the late 90s. I think the biggest change from a market structure standpoint to today has been the rise of passive investing, index funds, ETFs, custom baskets from the prime brokers and the like. And it has changed how bottoms up stock pickers like ourselves do invest. So for example, back in the 90s, if you were a value investor, you could rely on this concept that good cash flow in and of itself was a good catalyst. That's changed quite a bit today. There have been other well-known value investors that have stated, and I think they're onto something, that given market structure and given the fact that particularly among smaller capitalization companies, there has seemed to have been a lot of the coverage from the sell side has dropped there. So a lot of discovery of how these smaller value stocks perform has changed quite a bit. And so you've moved from an environment where cash flow generation in and of itself is not sufficient. And so these companies need to engage more actively in stock buybacks, large dividends, kind of create their own catalysts. And that is in large part a change from today. I also think a big change from back then to today is that relates to this. There's a lot of talk about a bubble today versus a bubble in the late 90s. And it'd be interesting to see. And I think the fact that we do have so much more passive and index funds today, that I think that could perpetuate a quote bubble persisting for longer and much harder to probably deflate it than it used to be historically when active management, I think, was a larger part of being the marginal buyer or seller of stocks. So that is definitely a change in market structure. It does have ramifications depending on what your strategy is within long short equity.
Yeah, that's really interesting. So I have two things I want to ask you about. The first is pertaining to some of the things you were talking about, small cap and small cap value and opportunities there. When I worked at Fidelity SAI, we actually did a deep dive study into opportunities and where active management can really pay off. And we've even seen that recently, even though the dynamics in the small cap world seems to have changed substantially in the last, say, 5 years. The one thing that has held true is that active management does matter. And so I think that I'd like to get your thought process on why that is persisting. And then secondarily, I want to dive into your comments about the bubble because that
Sure.
is a hotly debated area. That is something that people continue every day on CNBC, on Bloomberg. They ask each other, are we in a bubble as it pertains to AI and things of that nature? And I have my own opinions on that. I started in the business right around the 99 2000 bubble. Um, I wasn't necessarily managing money like you, but I was actively paying attention to markets at that time, and they felt really different, like really different. And the companies that were, really benefiting from trends and enthusiasm weren't real companies at all, and there was all kinds of IPO activity, and there was the analysts that covered those stocks were rock stars, like, you knew who they were. Mary Meeker is a great example, right? You knew these people, like, I don't think it's even
Roger
remotely the
Meeker.
same today.
Yeah.
Yeah. I don't even think it's remotely the same. So, what are your thoughts on that discussion and that debate? So, let's start with small caps and then go to the bubble debate.
Sure. Well, small caps are interesting. I have some specific thoughts on small caps, so maybe more broadly, the active management piece.
Mhm.
I certainly think since we launched Crescent Rock in the fourth quarter of 2018. So in that sort of 7 years, we have had what feels like a couple of market cycles, right? So we had, when we first started, we were talking about real rates being around, just coming off zero bound. Then we got into COVID and the monetary and fiscal response that was overwhelming. And then we've got into a rate hike cycle, inflation we haven't seen. So there have been a lot of cycles in the last 5 years, which I think has led to you literally have to be active as an active manager to navigate those market environments. If you look at the decade between the great financial crisis and COVID, decade plus, so that 12-year period, it was actually much different. There was a real argument to be made with was active really doing a lot there because you had an unusually long cycle where one factor or style persisted. Value lagged tremendously, and it
Mhm.
was growth and quality and compounders that just sort of carried a day. And it felt like if you were latched onto that, active management didn't really have a place. But that was a really unusual part of the cycle. And I think what we've seen, at least since 2018, when we launched, is a more typical market where every 3 or 4 years you have some shifting dynamic in type of style, whether it's large cap, small cap, value, growth. And as a result, active management, I think, has a bigger place to play in that type of environment.
Mhm.
In terms of small caps themselves, it's interesting. So the narrative, one of the narratives today is that small caps have underperformed the last few years, and we're going to revert to the mean. And obviously, for the month of January so far, that is playing out. Small caps are handling out. But I think when you look beneath the surface, it's not that simple. You can make the same argument for what was going on in value from say 2010 to 2020. There's these are the reversion to the mean is a standard argument, and that usually does work. And there was this thought process in that sort of 10-year period that value traditionally outperforms growth, and small caps traditionally outperform large caps. That is all true. And so that's a strong mean reversion that people like to play. And year after year in that decade, value lagged and lagged and lagged. And the question is, why is that? And if you look beneath the surface, there are other things that are going on that make a difference. So, for example, in value, a large portion of value are financial stocks. Well, financial stocks, making up a large portion of an overall value set, went through a structural change in that time frame. Coming out of the great financial crisis, we had a backlash of regulatory response that pretty much degraded quite meaningfully the return on equities that banks could earn. And so that meant a big drag for value stocks writ broadly because financials are underperforming. And then we got into later in that 10-year period where the global economy started moving to a zero bound rates, real rates that were basically nominal, pushed down the yield curve, pushed down the steepness of the yield curve. Also bad for banks. And so while value typically reverts, you have something really structural going on underneath the surface. So let's fast forward to today and the concept of small caps. Small caps generally do perform out large caps, but even after 3 years of underperforming, other than pockets here or there, are small caps going to have their day over the next 12 months? I'm kind of suspect because it's the same dynamic. If you look underneath the surface, let's use the Russell 2000 as a broad barometer. If you look beneath the surface of small caps, what you find is about 40% of those companies do not earn a profit, they do not have cash flow. So they are effectively long duration assets. Even if they're an industrial company or a long duration asset that needs access to capital markets. I'm hard pressed to argue that access to capital is going to get any better than it has been in the last 3 years. We've been looking at rates. Credit spreads are exceptionally tight. Private credit is readily available. Banks, while they were slow a few years ago coming out of COVID lending growth year over year is about 5-6%. Now, you can argue that banks are going through deregulation process now, and that's true. And that will free up a lot of capital for them to lend. That's also true. But at the same time, the appetite and needs of the larger players in the AI theme are basically gobbling up most of that capital available. So that part of small caps needing access to capital probably is not getting better. And at the same time, when you have 40% of those indices basically are long duration assets, you're really dependent on what's going on with real rates and the 10-year rate. And given the deficit spending going forward as far as the eye can see, and the fact that we're close to the end of the rate cycle, there's a good chance we're going to have upward pressure on the yield curve. And a large portion of those long duration small caps are going to really struggle. So I'm not so sure we're at the point where we're going to mean revert on small caps when you look beneath the surface. That doesn't mean there aren't specific opportunities. But broadly speaking, I'm not so sure small caps are ready to have their day in the sun again.
Yeah, I covered small cap value when I was at Fidelity SAI. I also believe the IPO environment has some impact on this. You have the rising star, falling knife scenario, but if you don't have IPOs coming out earlier in the maturity of companies, there's a lot less rising stars and a lot more falling knives. And the Russell 2000 is probably the worst of the small cap indices for this phenomenon. The S&P 600 is a real quality filtered index for small caps, whereas the Russell 2000 has all the junk in it, like all the junk, the penny stocks, everything. And so active management really matters there because you want to avoid as much of that as possible, as just evidenced by the fact that it's 2,000 stocks versus 600 stocks. You're looking at really the universe of opportunity if you're an active manager that has any sort of quality screen and is looking for, as you said, cash flows and things of that nature. Your universe is really 600 names, not 2,000 names. And that I think matters a lot. And again, I think the IPO market issue, things that come out in IPO now are so much more mature. They like skip the small cap market cap index altogether. All of those things, I think, influence small caps. So I think your points are good ones, but also brings to bear the fact that active management in that space is particularly important because it's way more important to avoid the disastrous falling knives than to own the winners, as which is almost certainly the opposite as you get into the mega caps. You
Yeah,
got to own the winners. It doesn't matter if you own some less successful companies. If you don't own the winners, you are dead in the water. And I don't think that phenomenon exists as much in small caps. I think it's entirely the opposite of that.
That is true, but it harkens back to the first how we started this conversation on market structure. Even amongst those, let's call them better quality, smaller caps, the fact remains that the amount of money chasing the smaller capitalizations through passives, through ETFs, through index funds is not what it used to be. And a lot of the sell side coverage on those names is not what it used to be, just from a business decision for the banks that cover it. And as a result of that, even amongst that more quality, smaller cap, you do need to ferret out the ones that can stand out by creating their own, more of a self help, creating their own catalyst. It's the only way to stand out because you don't get that discovery of these names like you used to.
Mhm. Yeah, I also think in that vein, I'm gonna very quickly kind of inform our audience of something that maybe they never thought about, which is how indexing works and why this is important in the small cap space. So indexing, when you're indexing the S&P 500 is fairly easy. You just buy the 500 names in the S&P 500. They're fairly large in market cap. They're very liquid and it's easy to buy all 500 names to replicate the index. When you get down into smaller cap, that's not the case. So you're optimizing. And so it's an indexing, but it's not the same. So if you are investing in a Russell 2000 index ETF or a mutual fund, let's say a Vanguard or whatever, you're not getting all 2000 names in the Russell 2000. And that's because there's a whole bucket of names in the Russell 2000 that have zero liquidity.
Right.
So it's somewhat optimized. And when I worked at Orion, we managed direct indexing portfolios and we did all this optimization. And even we were owning all 500 names in the S&P 500 or the Russell, all 1,000 names in the Russell 1000. We are absolutely optimizing. And that's particularly true in direct indexing because there's a tax management aspect to it. And you can't tax manage something if you don't have the ability to do tax loss harvesting. So you can't own everything and you have the wash sale problem, so you gotta be conscious of those things. But ultimately, indexing is not what a lot of people think. In fact, with the exception of, say, the S&P 500, most indexes are an optimized version of the stated index, which is really just a basket of non-traded stocks that some company decides should be an index. The investable aspect of it is almost always optimized, and the less liquid and the less traded the security, the more optimized the index. So in bonds, it's even worse than in small caps and so on and so forth. So I just want our audience to be aware of that as we talk about these things, because it does matter. Now, to segue into the second part of my initial question, as it pertains to the bubble. We talked about that. Um, there's a lot of talk about AI being a bubble. And when
Right.
I think back what it felt like in that 99, 2000, 2001 time period, like I said, you had all these analysts who were like literally household names. Like everybody knew Mary Meeker.
Right.
Everybody knew the Janus crew that ran that Janus mutual fund. The portfolio managers were literal rock stars. Like people it reminds me kind of like Kathy Wood. Everybody, like 5 years ago, didn't matter. Your cab driver, your kid's teacher knew who Kathy Wood was because she just had that. It was like that with all of those managers. They were essentially massive household celebrities. And I think that along with the fact that most of the companies that were IPOing because they could, not because they should.
Right.
And they weren't making money. And I just feel like the discussion of a bubble today has more to do with expectations and not necessarily are these companies going to go bust because most of them are actually generating revenue. Whether or not they're profitable is a different story. But back then, there were companies that weren't even generating revenue. It was just a wish and a dream, and somebody would just throw money at you. And so I'm curious, as you think about these discussions and you evaluate them, you talked about how you feel like this passive indexing is kind of exacerbating the bubble phenomenon. Is it that you believe that it's a bubble or like a slow like leak?
Sure.
You can have a bubble and then there's like your tire has a bubble in it and that's awful because when it bursts, your tire is just going. Or you can
Yeah.
have like a slow leak. And I feel like this is more slow leak.
Yes, and to be clear, I think that that dynamic market structure will result in that what you're describing. I don't think we're there yet, though.
Okay.
Like if you were to ask me, are we in an AI bubble? My answer is no, not yet. Do I think we'll overspend on AI compute? Absolutely, but we're not there yet, and we're not close to there yet, in my opinion. Look, there are certain things that look very similar to 99, 2000, right? Valuations on an absolute basis are high. There's no real equity risk premium in the market. There's concentration at the top of the industry. There are market darlings, maybe not the personalities, but the companies. And so that's all very similar. And there's a tremendous amount of capital expenditure going on with what's called some transformational technology. Well, that's the same. But you pointed out some differences as well. And those differences are real. One, those companies that are crowded at the top of the indices are real companies with real balance sheets, real cash flow, real businesses, real quality businesses by and large. So that's a vast difference to what we had back then. Secondly, valuations today, amongst that group and Rick Broly are not what they were back then, not yet. And as far as the capital spending that's going on, back then, a lot of capital spending was fiberized telecom fiber. And we were putting into the ground a lot of quote, dark fiber, unlit fiber, which is a fancy way of saying overcapacity. No one is complaining yet today that we do not have, that we have overcapacity in compute. Now, the returns on the capital might not look great. And that was a problem that Oracle had in the fourth quarter when it leaked out what they were making on some of their cloud offerings. But that's different than saying that we're at a point now where we have overcapacity compute. We don't. So it's different than the dark fiber phenomenon that was going in. We were literally putting capital in the ground that was not being utilized. That's not what at the moment is going on. To your point, it's what's going on the line 2, 3 years from now. Will we get overextended? Possibly. Is OpenAI a potential problem? Absolutely, because they have wended their way into all sorts of facets of the market. And if they do not make it, they're going to pull everything down around with them because they are not, quote, too big to fail, but they're certainly big enough to cause a lot of problems for everyone else. But I don't think we're there yet. I don't think we're in a bubble. We have the potential to it because a lot of these large companies view that AI is an existential threat if they're left behind. And so they will spend, they have access to capital, they have access to their own balance sheets, their own cash flow. And so they will spend it. And I have no doubt that we will overspend and maybe get subpar returns. But I just don't think we're there yet.
You mentioned something about valuations being elevated. And I like to remind people there's actual valuations, though. When we
Right.
look back at 99, here's the thing. We always look at comparing PEs. And one of the interesting thing about PEs is if you don't have one, you don't get in part of the calculation, right?
Correct.
So the number of companies that are in the S&P 500 that are actually have earnings is much higher than the ones back in the day. So it's hard to do a comparison of valuation of an index on a PE basis when like more than half of the names back then didn't have earnings. So they weren't even in the calculation. If you don't have earnings, it says NA next to you. And
Yeah.
you
For some of
can't
those
average
companies,
you can't average a nothing burg. It's not even zero. You can't even it's a no number.
you can't even default to price to sales for some of those companies.
Right.
They're sales.
Exactly.
So it's a different dynamic. Yeah,
Yeah, so
absolutely.
when we talk about, the valuation, but the valuation is based on the average or the median of the peer group, and if there's literally no number, they just get left out. They're not even in the sample, and you're talking about 500 companies that actually have PEs versus maybe, and I'm just making this number up in case anybody wants to test me on it, like 100, right? So 100 companies that were making money and had earnings and revenue and sales versus all 500. And that I think is a different dynamic that I think is worth noting every time we have this conversation about
That's
valuation.
definitely a false equivalence.
Yeah.
All that being said, I think the building blocks are in place for overspending
Yes.
and ultimately some level of excess capacity and maybe suboptimal returns, maybe excess capacity, but it's early days. And so I don't see that derailing anytime soon, certainly not like we saw in 2000.
So Crescent Rock is a global manager. So your
Sure.
opportunity set goes beyond the borders of the United States of America. As you think about the global economy today, and I'm actually going to make some connections between 99 2000 because we're talking about it. And I think that this is relevant. 99 2000 was a period of time where the economy was becoming more global, right? So we were shifting to a global economy, which had a different impact on the way you might view and evaluate names overseas than today, where we have the deglobalization going on, like the exact opposite environment where countries are being more domestically focused. There's less global cooperation. We have Trump tariffs, threats of buying Greenland, like all kinds of weird stuff going on, which was couldn't be more diametrically opposed to what was going on in 99 2000. So 26 years ago, 27, 28, 29, 30 years ago, there was a huge push to the globalization of the economy. Let's work together. Let's have this whole economy benefit from everybody's participation. Whereas now, exact opposite. So, how does that impact the way you evaluate the global opportunity set?
Yeah. Well, one thing I would say is if you think globalization is good and deglobalization is backtracking from that is bad, from an active manager's point of view, particularly one that does longs and shorts, a period of change and disruption is the best environment, no matter what the absolute direction is in terms of good or bad. So when you have the ability to go long and short, you have the ability to take advantage of change from either side of your portfolio. So that doesn't really make a big difference, but the opportunity set is different. And when you do go globally, even within developed markets, there are other market structure issues you need to consider, even more so than here. So, from an opportunity set standpoint, you certainly have the economies that are, fully synchronous, right? And so, take Europe is in a mess. Europe is in a very poor energy position and a very poor welfare state position. And you would say, boy, even from taking longs in Europe must be incredibly hard.
Well, just
Well,
to point out to our audience, the euro didn't exist in 99 and 2000.
right, right.
And I think there's a whole generation of people that don't understand that, like, the euro happened during that time, like, the whole move to euros, that changes the dynamic in and of itself.
Correct. But there are still opportunities. Because one, the market's priced for it. You have certainly different valuations you have to Europe. And Europe, despite going in one direction themselves, they have something that they're going back in another direction, which is when we'll see how this plays out. But Germany going off of pure fiscal austerity to something that looks like, at least for them, profligate in terms of fiscal spending. Now we'll have to see, does that make its way outside of the defense sector where valuations are rich? Or does it just go into the welfare state? That remains to be seen. But there could be some opportunities there. Then you go to Japan. Japan, after a couple generations, multiple decades of being sort of a value trap, you just started getting sort of green shoots in the last few years of a move to encourage getting rid of excess capital, using the buildup of cash positions on those domestic companies, then getting it back to shareholders. And activism is finally getting a bit of a toehold in Japan. So there are like different opportunity sets when you're in different asynchronous environments between the US and, let's say, those two big developed economies. That being said, we talked about small caps. Once you go a far from the US, it becomes even a little trickier to deal with small cap and the lower end and mid cap realm because everything's driven by macroeconomics. But certainly in Japan and even Europe, not just macroeconomics, but money flows has a big impact, even more so than here in the US. And so what goes on in the macroeconomy can make it very hard for smaller cap companies to really break through in those geographies. And so I think it's more important when you're looking in those geographies amongst the smaller caps and even the mid caps, it is really important to be identifying catalysts to help drive value. The chance of a value trap in those economies, I think, is higher than it's here in the US. So not is only the opportunity set different, you have to approach it and think about how you're going to make your returns a little differently than you do in the US. It's even harder in small cap arena there than it is here.
Yeah, I'm loving this conversation because as we're having it, I'm being brought back to what the world looked like back then and how incredibly different it was. You mentioned Japan.
Yeah.
Remember when Japan was like the laughing stock because it was like the 80s and then the entire 90s and most of the early 2000s, Japan was like one of the worst markets to be in because it had deflation for like decades and it hasn't actually gotten back to where it was when it peaked in the 80s, right? But only recently. So it's been like 30, 40 years it took for it to regain from the peak in the 80s to today. So there was literally decades of which that market did not revisit its highs for
Right.
the from the 80s. And I think that's really interesting because, for most of my career, Japan has been, like, the place you don't go, and now it's different, and there's so mu the Euro thing, it's amazing to me as we're talking how much has changed and how different the dynamics of the market are, but I don't know that anybody really thinks about these things. You know, people go on TV and they get 2 or 3-minute sound bites, and
Yeah.
I'm one of those people, and doesn't give you a chance to dive into some of these things and really have the thoughtful conversations by any stretch. So, one of my favorite books is a book called Blaming Some of the People All of the Time. And I'm not sure if you're familiar, but um, uh, it's a book. Joel Greenblatt, is that the right?
Oh, sure. Yeah.
Oh, shorting and how
Yeah.
hard it is to be a short. There's
Yeah.
another book. It's not quite as entertaining to read because it's super heavy and technicals, which is called "Don't Blame the Shorts." But one of the things that always struck me throughout my career once I started working with managers that shorted in varying degrees, whether they be long short or short biased or whatever, is how difficult shorting is. It is so much harder to get your shorts right and to stay short. I have a really good friend back in the day who happened to marry her husband was the CEO and founder of a major technology company, and I won't say what company it was, but I remember sitting at, like, their pool one summer and him just going off on all the guys that shorted his stock, how much he hated all of them, and sitting in meetings with long only managers when you would press them on a company they might own that had a heavy short interest, how they would literally just knock the shorts as being bottom feeders and evil or whatever. But they have a really important mechanism in the market. Shorts are incredibly important for creating bottoms, especially in times of stress. So I'm curious, as you think about what it's like being a long short manager and the nature that you're a long short manager, which is different than, say, a ETF or mutual fund that has complete transparency and limitations to the short. A lot of times the shorts are rules based, and these managers aren't actually making fundamental bottoms up selection of the shorts. Talk a little bit about what that is like and the difficulty of it and how you have been able to kind of succeed in an area that is fundamentally hard. The market goes up way more than it goes down.
Yeah. Yeah. So you're absolutely right. I mean, everything is structurally working against you when you short. Uh, Companies have every incentive to move in a different, they might get their stock moving in the opposite direction for compensation purposes, obviously, and job preservation purposes. The South Side is just chronically incented to be bullish. And you're right, the market clearly generally lifts with growing economies. And so you do have everything sort of stacked against you right out of the gate. Um, there's a lot of different ways to short. One thing I've learned that we're doing over the last 25 plus years is that you do have to adapt. in terms of how you approach it. Now, we've been quite successful on the short side. We run actually consistently good alpha on the short side, even more consistent than we do on the long side, which always surprises me. But when people talk to us about our short ideas, they're often very surprised about how it gets done. There's this concept and this view of a short seller being some sort of swashbuckling approach to finding frauds and accounting irregularities and making 50, 70, 90% on a short. That does happen. That is out there. That's the sort of the picture of the shorts. That being said, that's not how really most of it's done. It's certainly not how we do it. Our shorting is very pedestrian. People, when we go through our short ideas with people, are like, that's kind of a really boring idea. And actually, boring ideas really work in shorts. But since everything is stacked against you in shorts, when you're looking for those quote home run type shorts, those frauds, those accounting irregularities, that type of thing, what you find is one, they're very crowded names. There's not a lot of great short ideas out there. There's not a lot of companies that actually fit that parameters. Our markets are efficient enough that they flush a lot of that out over time. That there aren't a lot of those type of names, and they tend to be very crowded, and they tend to be very binary. And to be successful on the short side, even more so on the long side, it is important. It is more important to control your losers than making winners. As important as on the long side, it's even more so on the short side since everything's stacked against you, and since you theoretically have no cap loss being short. So as a result of that, those high quote profile names, they're crowded. They tend to be binary. When you get them wrong, you really get them wrong. They're prone to short squeezes. They're prone to the meme stock mania that started sort of in January of 21, which was a sea change in how you had to approach shorting. So we find that singles and doubles on the short side, quote, boring pedestrian ideas, is really the way to make sort of an all-weather type short portfolio. And so the best shorts tend to be decent companies, even sometimes really good companies that at the margin for some competitive or secular reason are getting worse.
Mhm.
And that usually is enough to make, a good short return on the stock while avoiding a lot of the pitfalls and risks. They're not highly shorted names, so the management's not out there pushing against you. The sell side's not pushing against you. You're not, borrow rates not expensive. The borrowers are not getting tight. You're not risking getting called in on a borrow. If you're long, you're not getting squeezed. So it's much easier to control your losses. If you can control your losses on the short side, they'll generally do pretty well over time.
So when you think about your portfolio, are you pretty consistent in your net exposures? And for the audience, what that means is your longs minus your shorts. You get like a net exposure, net long, net short. Are you pretty consistent? Or if somebody were to look at your portfolio, would they be able to tell your view on current market environments by your net exposure?
Yeah, it's interesting. So for the bulk of the 7 years, I would say our net does stay in a band. It usually ranges from say 20 net to sort of 35 net. It's sort of the band we're typically in.
Mhm.
But and that, why is that? Because a lot of time in the marketplace, there's not a real quote regime shift going on with monetary policy or fiscal policy. A lot of time is spent in the belly of the market cycle where there's not a lot that's necessarily going on except noise from a macro perspective. Like I said, the last 7 years has been a little bit more shifting than the prior 10,
Mhm.
closer to normal. But we do deviate outside those realms when there's a significant change. And so we will be higher or lower at what we view as real change points. Right after COVID, after monetary and fiscal response, you might get a more dramatic change. In this type of environment where you're in a rate easing cycle, like most recently, you might get us more outsized net to the upside. In a tightening cycle, you might get us more compressed down to low side. We never go net short on our portfolio. I think the lowest net we've probably had has been about 10. The highest net we've had has been about 60. But 80% of the time you'll find us in that We've averaged since inception 27% in the 7 years. And I would say the bulk of that time is spent between 20 and $35 and beta adjusted.
And I want to point out to our audience because this is something I sent over to you earlier, and you're like, I don't know that I can speak to that, but I
Yeah.
can. And I want our audience to kind of know this. Why you would work with a firm like Crescent Rock and not a long short ETF or mutual fund is exactly what we're talking about here. The limitations of the 40 Act really make it so that a long short ETF or mutual fund is always going to be net long way more than any hedge fund could be, because hedge funds don't have the constraint of how much they can short and leverage, whereas 40 Act funds do. So keeping that in mind, when you're looking to evaluate long short managers and whether you're comparing them hedge fund strategies that are private placements or not registered versus a registered product, or looking at things in kind of a vacuum or all in a combined universe, unlike traditional investment styles that are long only, like equity or fixed income, it does matter in a filtering system, these net positions, because the nuance here comes from the actual underlying investment philosophy and how much a manager might be long or short. So a firm like Crescent Rock, it tends to be, as you said, in that 30, 35, 25% net long bucket. But comparing of 35% net long manager to one that is chronically 70% net long or 60% net long is it's not a fair comparison. It's apples to oranges. And so understanding and evaluating things based on apples to apples becomes important. Maybe you can speak to why somebody should be considering an array of net exposures and considering why those net exposures matter, and then how one might address like a performance evaluation of someone based on how they view net exposures. Because I think our audience would find that useful, as this audience tends to be one that it starts with that registered product liquid and then moves into the hedge fund world. And then it's so different, it's really difficult to wrap your head around and get comfortable with it if you don't fundamentally understand why being able to be net long 35% could have benefits if a registered fund could never get there.
Yeah, that's a good point. And it really is sort of a spectrum, I guess, on the ultimate client's needs and desires. If you think about just an individual stock and over a 12-month period, where the returns from that stock come from. They mostly come from what's happening in the overall market. Secondarily, they come from the style and sector. Is it a value stock? Is it a tech stock? And then lastly, it comes down to the individual stock itself. So those are sort of the three ways in any relatively short period of time that drives a stock. So when you're starting to short, now there's two ways to short. And there's a very important dynamic going on here that you need to understand when you evaluate short funds, is that there's some level of acknowledgement when you're running a long book and a short book. There's some acknowledgement that you're naturally trying to take that quote market driven return out of the equation to something, or at least tamp it down. And why would you do that? Well, amongst the three vectors that you can evaluate where a stock's going to perform from, the market tends to be the most difficult to assess. And so running a long short strategy almost by design is some acknowledgement that that being the hardest part to assess, you may want to tamp down the volatility around your returns that are driven by the market itself. And so that's sort of the starting point for, I would call, a long short portfolio that is geared to be hedging. Now, that's not the same as a long short portfolio that is not necessarily trying to hedge. I could construct a long short portfolio where I'm not even necessarily hedging. I'm actually layering my bets. So, for example, I can have a long position and a short position that in a market environment, they should kind of hedge each other. but I can also construct a portfolio where my long position works, and in the same environment, my short position works. And in that environment, that means if you get something wrong, you're getting it wrong on both sides of your book. And so even though you're carrying a relatively lower net, all you've actually done is created leverage, and you created a whole lot of volatility. So there's two very different ways to approach long, short equity. We do the former. We're often trying to dampen down that market-related driven return and not layer leverage or leverage our bets per se. So it's not enough to just understand the net exposure. You have to understand the investment philosophy approach in terms of, am I trying to magnify my returns, or am I trying to hedge at some level? But you also have to understand your gross. You can run a long short portfolio like ourselves, where we're on average 100 long and 70 shorts, or 170 gross. That is a lot different than somebody running 150 long and 140 short. Now, they're 10% net, but they're almost 300% gross. They're going to not necessarily have lower volatility around them than we do. So you have to look at the net leverage and the gross leverage to really get a sense of what sort of risk is being taken there, which gets to your second point, which is what part of the returns, what don't they tell you? Well, returns do not tell you the risk undertaken to generate that by any stretch. They don't tell you how we got to that level of return. Did you take a low level of risk, or did you take a high level of risk to get there? That's important to understand. Secondly, what the returns also don't tell you is, are they durable? So I'll go this example I flagged a couple times. Let's take that 2010 to 2020 period. You may have a very astute, excellent, growth-oriented manager. That's what they do. That's what they understand. That's what they excel in. And they found you looked at their track record in a period in which the wind was always at their back. Well, is their approach and their philosophy durable when the market cycle changes and maybe go back to a more traditional value outperforming growth? So the returns don't tell you that unless you understand their philosophy and their approach to getting there. So there's a lot more to understand than just the returns. And I think I think a lot of people find surprising, more so with hedge funds than say mutual fund, is that when you peel back an annual return and look underneath the surface for most hedge funds, I think sometimes investors would be surprised to see that even if you have a relatively, quote, diversified hedge fund, they're generally not as diversified as a mutual fund. And as a result of that, their returns are a little more concentrated in just a handful of names.
Yeah.
So in any given year. And so that's what creates some of the lumpiness over short bursts of time in a hedge fund, which is maybe those returns congregate in the fourth quarter, or maybe they slip to the next 12 months in the first quarter. And so there's not necessarily smoothness, because the inherent concentration of most hedge funds results in, I can match the market return, let's say. But if you look beneath the surface, I probably got there with a lot fewer names. That means there's probably a lot more volatility around.
Yeah, that makes a lot of sense. As we come up on our time together, I am left wanting to ask you, since the vast majority of our audience probably has never sat down and met with kind of a pure play hedge fund like you guys are, what questions do you think are really important for an advisor to ask in those meetings that you don't think even the institutions ask enough? What questions do you wish you got asked that you think would help better portray who is worth investing in and not worth investing in your viewpoint?
Yeah, I think, given the inherent concentration and a little more of the volatility around individual returns, like I was just describing for the vast majority of, let's say, long short hedge fund managers. And honestly, versus a lot of our peers out there. They run a lot more concentrated than we do. So this is even more important for them. You really do have to understand, at some level, you need to make a commitment that I'm probably, to really get the benefit of this manager, I'm probably going to be investing with them for a couple of years. It's not, I'm going to invest in 6 months or 12 months. And so when you start moving into I want to put capital with them to really, get the return out of them that I can over a few years period, at a minimum, a few years, you do have to understand, like I was saying, where are the returns coming from and how much of it is just related to a style bent that they're kind of riding, no matter how talented they are, they're riding a wave. How are they going to handle a change? Do they have a philosophical approach to investing that allows them to still be able to manage well if the market dynamic changes? And I'm not talking just about the market being up or down. I'm talking about as to what's working will work. Small caps versus large cap, value versus growth. There are these shifts. And as I talked about, they can last for years. You could have been a very talented value investor for 20 years and it had a 10-year wasteland between 2010 and 2020 because just the wind wasn't at your back anymore and market structure changed a bit. So I think investors should do a better, should be focused on that aspect of sort of the durability of the strategy in different market environments. And not, I'm not talking about the market being up or down. The other thing that's changed dramatically from when I first started in this business, particularly, and this applies maybe more to long, short fundamental investors than say other hedge fund strategies. But when we would have conversations with potential investors, there was a lot more emphasis and attention paid to what ideas you're invested in, what longs you're invested in, what shorts you're invested in. There's a much more broad discussion and deep discussion about what actual is the opportunity set you're invested in. Today, most of our conversations in our meetings, despite the fact that we're fundamental, despite the fact that we tend to be bottoms up, is around topics of interest rates, macro, geopolitical. And I get why, but that's started and has persisted even before dramatic shifts in the market environment. And I think what gets lost in that is that's where I think there becomes a disconnect between sort of the intent and the expectation of the investor and what's being delivered to them. Because it's much easier to intuitively understand, okay, I've talked 10 or 15 stock ideas with this manager. I kind of know what they're invested in and how they think. So I could kind of have probably a sense, if I'm an institutional investor looking at the market, probably how they did. It's much harder to, and there's much more surprises crop up when all you focused on was their big picture and you're not quite understanding what they're actually doing on a granular basis. There's much more room for surprise. And that's not beneficial for the investor or the manager. Surprise is usually a big, just a really not fun situation for anybody.
I always say, and I reiterate this as much as possible, especially with our analysts here at Bonrian when we are doing our research reports and such. And this is something that was hammered home with me in a massive way when I was an institutional allocator, which is that our number one goal in every meeting and every manager assessment was to understand and set return expectations. Because our goal was that we did not necessarily want to or need to, every time something happened in the market, have to call the manager for an explanation on their performance. We should have done enough work in the beginning to intuitively understand what market environments a manager would succeed and fail. And therefore, if a manager's performance at any given time we were doing an evaluation, I should be able to be like, well, yeah, that makes sense because this is what they focus on. This is how they choose and select stocks. And I would expect that in this environment, that this strategy would perform in this manner. And it also ensures that when you hire a manager, you're going in eyes wide open and that you're not firing them for performance that is completely anticipated. should have anticipated that kind of performance when you evaluate a manager. I think it's a lot easier to do in the framework that a lot of institutions work in, which is when you're building a portfolio of a lot of managers in the same, like, grouping. So,
Right.
like, I'm hiring 5 value managers, I'm hiring 5 growth managers instead of just one off and just mishmashing things together. Because when you do that, you have to understand how each value manager is different and what drives each manager's returns. And there's an expectation that they're not all gonna work the same way at the same time. That's the whole point. So you have to understand that nuance. And that's why on the institutional side, I always say, in all the years I worked as an institutional allocator, I never fired someone because of performance, except for one time. And the one time we fired a manager because of performance was because of they actually outperformed. And the reason that was problematic is they were a value manager that had shifted in a way to get that outperformance that no longer aligned with the value manager attributes that we hired them for. And so, because they changed in such a dramatic way that it was out of alignment with the predictability of the returns that we hired them for, we had to fire them. But I never, in all of my years, fired someone for underperformance. Because if I had to fire somebody for underperforming outside my expectations, then I probably didn't do my job, which is to understand when somebody would underperform. So I hammer this home with my analysts, and I hope our audience walks away with this because you basically said what I believe philosophically is the most important thing when evaluating managers is you should be able at the end of your evaluation period when you make that decision to know intuitively, this is an
Right. And
environment a manager would do well in, and this is a manager that an environment a manager should do poorly in. And the only time a discussion should come up or a flag would come up, because we would green,
the
red, yellow flag every quarter, is when that outcome does not match your expectations, because that would either mean you did something wrong or they've done something different. And those 2 things both matter. And ultimately, I view our job at Bonrian and our analysts, and I think exactly what you're saying is I view our job is to make sure that I properly understand performance expectations, because then there are no surprises. And if it's hard to evaluate and understand performance expectations, then it becomes a decision on conviction of the team talent, which you're kind of laying your neck out. And to your point, very few managers, even if they can't articulate or doesn't have something that they are locking into that is actually pretty repeatable and predictable. Whether or not they know that maybe their momentum at a reasonable price, or that they may not think of it that way. They might be like, "Well, I'm just a good stopper," but there's a factor that they tend to bias towards, and you can figure that out through regression analysis and all kinds of other stuff. But ultimately, it's your job before you make that decision, whether it be as an institution for your institutional portfolio or as an advisor for your clients. Your job is to walk away before you make a decision with a really clear understanding of a manager's performance expectations. And if you can't, then it's probably not the right manager. You probably still have more work to do. Because ultimately, you should never have to always call the manager for an explanation at the end of every quarter for their performance. You should intuitively understand, well, yeah, that makes sense. And the only times a conversation occurs is if, for whatever reason, it doesn't make sense. So, to your point about positions, I like to go into meetings evaluating all the names in the portfolio with some idea or understanding of what the underlying philosophy is from a fundamental standpoint, and pick 1 or 2 names that just me, not knowing the names like the manager would, don't seem to fit, and explain to me how they fit. And
correct.
they either will or they won't, or they'll tell me, "Oh, I sold it," or whatever. But ultimately, that's how I would go into those meetings, is like I'd look at the portfolio of 100 names and be like, okay, so this manager focuses on intrinsic value, value some of the parts analysis. And as I'm looking at this portfolio, there's like 3 names that don't fit that criteria. So I need to understand what I'm missing because I don't know these names like they do. And they'll either be able to explain it or they won't. And I think that's kind of the point you're making. You wish you got more questions like that than like, what's the macro environment doing? Because I ultimately think a lot of people go into meetings asking those questions because they care and not necessarily because it has any impact on evaluation of the portfolio. They just want to get as many opinions as possible so that they can make personal decisions. And that can be useful, but there becomes a point that a lot of fundamental managers are like, look, it matters, but it doesn't.
Yeah, no, and I'm not trying to imply that it doesn't matter. The question is, how does it get brought down to
Right.
the positions you're investing in? Because it's in everyone's interest for, as you say, there not to be surprises.
Right.
And so you have to talk about all of it.
Yeah. I really, truly appreciate your time today, Michael. It was a pleasure having this conversation because this is definitely different than some of the conversations we've had over the years with folks that come on the show. And I think that is a result of the fact that we've never had someone in your space, which is exciting because for the last 10, 15 years, I think a lot of people have stayed away from what I like to call the diversifying alternatives, which are hedge fund strategies like your own, because ultimately who wants to invest long short when the market's going up 30% every year, right?
Right.
But the market's more nuanced now, and I think it's time to revisit the conversation on why long short and what I like to call diversifying alternatives need to get a second look. And I think this is a good conversation that can help our audience understand how to start those conversations. So thank you again for your time. To our audience, if you have more questions or more interest in learning about strategies like Crescent Rock and learning more and really diving into strategies that maybe you haven't evaluated before, please let us know. We'd love to hear from you. And I know Michael would be more than happy to have a conversation. With that, this is What's the Alternative? I am Shana Orczyk Sissel, founder and CEO of Bonrian Capital Management. Remember to like this episode and subscribe, and please leave a comment and let us know your thoughts on this episode and other ideas of things that you'd like to hear about and learn more.
Thanks for having me.
Let's go boom.
The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Bonrian Capital Management's platform. As such, Bonrian may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Bonrian Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Bonrian Capital trademarks mentioned are owned by Bonrian Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.